Welcome to The Explainer. Today, we're going to totally demystify the incredibly complex and, honestly, kind of opaque mechanics of corporate finance. We're popping the hood on multinational enterprises to see exactly how they're structured, how they measure their financial health, and how they magically move money around the globe. If you've ever skimmed a business headline and thought, okay, but what is actually going on behind the scenes? Well, you're in the right place. Okay, let's dive into this. When you think of a huge global brand, you probably picture one giant, monolithic company doing the whole shebang, everything from making the stuff to selling it. But the reality? It's way more intricate. Massive multinationals manage their empires through a super tangled web of legal entities, strategic financial reporting, and complex international tax strategies. To really grasp this, we need to do a little bit of corporate anatomy.
Act 1. The skeleton.
Because, you see, a multinational enterprise is rarely just one single isolated entity. To grow, adapt, and protect itself, a corporation builds a highly specific structural skeleton. And sitting right at the very top of that skeleton, that's usually a holding company. In the absolute simplest terms, this is a parent company that owns 100% of the shares in an operating company, which we call the daughter, or the subsidiary. The daughter is the one out there sweating, doing the actual day-to-day operations, while the parent just hopes to benefit from the profits. So why go through all the headache of setting up this parent-daughter dynamic instead of just running one massive company? Well, two huge reasons: risk management and optionality. Think about it. If a daughter company gets hit with massive litigation or goes bankrupt, that problem is boxed in. It's quarantined. It doesn't legally infect the other sister companies or the parent. Plus, if you want to jump into a totally new business line, you just bolt another daughter company onto the existing structure. It's like playing with corporate Lego. Now, this structural skeleton can actually take a few different forms. A pure holding company, it does literally nothing but own controlling interests in other companies. That is its entire reason for existing. But a mixed holding company is a structure that owns those controlling interests in its subsidiaries while simultaneously rolling up its sleeves and conducting its own active business operations. And it goes even deeper. You also have intermediate holding companies. This is where a daughter company actually has her own daughters, becoming a parent herself, but still ultimately answering to the big boss, the ultimate holding company at the very top of the chain. Now, what's really interesting about this slide is how these structures play out in the real world to create some absolutely incredible leverage. Take Exor, for example. They're one of the world's largest diversified holding companies. Look at the massive difference here between their economic ownership and their voting rights. Exor owns just about 20% of the luxury sports car company Ferrari economically. But get this, they command 32% of the voting rights. Same thing with Stellantis. They only own 15.5% economically, but hold 24% of the voting power. This skeleton setup allows that ultimate holding company to wield massive controlling power over iconic global brands without having to tie up all the billions in capital required to actually own them 100%. It's a total game changer.
Act 2. The vital signs.
All right, once you've got the skeleton all set up, you have to monitor the health of the organism, right? To see how a massive company reports its health, we're going to use Microsoft's fiscal year 2025 financial statements as our patient on the operating table today. But before we crunch the numbers, you really have to understand the fundamental secret behind how financial reports capture time. The income statement and the cash flow statement, they're like a movie. They cover a specific period of time, say a full year, telling the whole story of profitability and cash moving around from start to finish. The balance sheet, on the other hand, is a snapshot. It captures exactly what the company owns and exactly what it owes at one specific, frozen point in time, literally like a photograph taken at midnight on June 30th. So let's press play on the income statement movie for Microsoft in 2025. Boom! This is the top line, $281.7 billion in revenue. I mean, that is just an absolutely staggering amount of money. It's astronomical. This number tells us exactly how much they sold over that 12-month period.
But if you're wondering where almost $282 billion actually comes from, well, if you guessed Windows or Xbox, you'd actually be wrong. A massive 2/3 of Microsoft's total revenue comes strictly from just two segments: server products and cloud services, and Microsoft 365. And the way they recognize this revenue is absolutely crucial. For subscription services like the cloud and 365, they don't count all that cash as revenue right away in one big lump sum. They recognize it ratably, meaning gradually over the contract period, as they actually provide the service to you.
And this brilliantly illustrates the story the income statement tells as we basically walk down the profitability ladder. Step 1 is that massive top-line revenue number. Step 2, we deduct the direct, literal costs of providing those cloud services, like, the electricity and hardware for running massive data centers. And that gets us to gross margin. Step 3, we deduct operating expenses. So things like research and development, sales and marketing. That gives us operating income. And finally, step 4, we deduct other random expenses and taxes to arrive at the absolute bottom line, net income.
When you look at Microsoft's 2025 margins after walking down that ladder, man, the vital signs are glowing. Their gross margin is an incredible 69% of revenue, their operating income is 46%, and their net income, the pure, unadulterated profit left over at the very bottom line, is 36% of their total revenue. I mean, wow. Keep those incredibly healthy profit-generating margins in mind the next time you're paying for your Microsoft Office subscription, right?
Now, if we switch gears from the movie to the snapshot, we're looking at the balance sheet. And the golden rule here is that a balance sheet must perfectly balance out. On the left side, Microsoft has $619 billion in assets, things they actually own, everything from straight-up cash in the bank to those massive data centers. On the right side, they have their liabilities, that's what they owe to suppliers and creditors, plus equity, which is basically the book value of shareholder capital. What's really fascinating here is that equity makes up a massive 55% of this entire balance sheet. And the bridge between those incredible profits we just saw in the income statement and this massive equity on the balance sheet, it's an account called retained earnings. It's basically the giant pile of cumulative, historical profits that Microsoft just hasn't paid out to shareholders yet.
Act 3, the circulatory system.
So, okay, we've got the skeletal structure figured out, and we've checked the vital signs of profitability. But how do these massive multinationals actually move that profit around internally, especially when they're operating across international borders? Let's look at an example. Imagine a multinational enterprise that owns 2 sister companies. We'll call them MedDevice Ireland, where the corporate tax rate is a very friendly 12.5%, and MedDevice France, where the corporate tax rate is a much steeper 25%. So the Irish factory manufactures medical equipment for 40,000 euros. They sell it to the French sister company, who then turns around and sells it to a local hospital for 100,000 euros. The price the Irish sister charges the French sister, that's called the transfer price. And let me tell you, setting this price is a high-stakes balancing act. Let's move to the math and see how this builds into a massive tax incentive. If the company sets that internal transfer price really low, say at 40,000 euros, all 60,000 euros of the overall gross profit ends up sitting in France. It gets taxed at that high 25% rate, and the total tax bill comes out to 15,000 euros. But if they set the transfer price artificially high, let's say at 100,000 euros, well, the French company technically makes zero profit. All the profit stays over in Ireland, gets taxed at just 12.5%, and suddenly the total tax bill drops by half to just 7,500 euros. So obviously, the multinational has a huge, massive incentive to just shift all its profits to the lower tax jurisdiction. But hold on, they can't just pick whatever numbers save them the most money. The ultimate risk of being overly aggressive with your transfer pricing is something called double taxation. If the French tax authorities look at that and reject that high 100,000 euro transfer price as just completely unrealistic, they're going to mandate a lower price and tax the French company anyway. And if the Irish authorities refuse to lower their side of the equation, well, then the multinational ends up getting taxed twice on the exact same pool of profit. Talk about a worst-case scenario. So the crucial point is this underlying fundamental rule of international business: corporate taxes are paid where profits are earned. This is known in the finance world as the arm's length principle. Basically, the internal transfer price must be exactly the same as if the 2 sister companies were completely independent enterprises, just acting in their own self-interest on the open market. To prove their transfer prices are fair and truly arm's length, multinationals use a tool called a functional analysis. They have to meticulously document where the real value is actually being created. Think about it. If the Irish entity uses massive tangible assets, like huge factories, and takes on the risk of their inventory going obsolete, they absolutely deserve a share of the profit. But on the flip side, if the French entity relies on highly valuable intangible assets, like a proprietary marketing strategy, and assumes all the risk for product liability, well, they also deserve a justified share of the profit. You basically have to prove who genuinely earns the money based on the actual economic risks taken and the assets contributed. It's like a giant puzzle.
The big picture: corporate structures.
And that brings us to the corporate big picture. We've traced the incredible journey of how modern empires are built. We started with those skeletal holding companies designed to strictly isolate risk and leverage voting power. We examined the vital signs of financial health, seeing how giants like Microsoft turn an absolute torrent of revenue into massive retained earnings. And finally, we explored the circulatory flow of transfer pricing, where internal borders literally become a battleground for global tax optimization. So I'm going to leave you with this.
The next time you see a headline about a massive corporate earnings report, don't just look at that top-line revenue number. Ask yourself, what hidden parent-daughter structures, what strategic accounting methods, and what global transfer pricing strategies are really driving those bottom-line numbers? Thanks so much for joining me for this explainer, and keep questioning the mechanics behind the money.